Investing is like shooting arrows in the dark. Market rewards discipline, not guesswork. Backtests don't predict the future, but they stop you from living in illusions. Or yaad rakhiye, returns makes you rich, risk management keeps you rich. Backtesting, simulation, and way forward. Every cricket team practices before the big match. Every pilot uses flight simulator before flying real passengers. तो फिर इन्वेस्टर्स बिना प्रैक्टिस के अपना पैसा मार्केट में क्यों डाल देते हैं? That's where backtesting and simulation comes in. In quant investing, before risking even a single rupee in the live market, we run our strategies through years, sometimes decades of historical data. So let's do a deeper take into why backtesting matters. Market rewards discipline, not guesswork. Without backtesting, investing is like shooting arrows in the dark. कभी टारगेट लग गया तो लक, नहीं तो पैसा गया. Backtesting helps answer critical questions. Now, what are those critical questions? Would this strategy have worked across different market cycles? 2008 crash, 2017 bull run, 2020 COVID shock. What kind of maximum drawdown should I prepare for? Is it 25% or 40%? How often does it beat the benchmark? And सबसे important, does it give me the confidence to put real money on the line? Backtests don't predict the future, but they stop you from living in illusions. How backtesting work? Let's do a little deep down version. Define rules clearly. Example, buy top 50 Nifty 500 stocks by 12 months momentum. Rebalance quarterly. Clarity is critical. Vague rules is misleading backtest. Step 2 is to collect and clean the data. Adjust for dividends, splits, bonuses. Include delisted stocks to avoid survivorship bias. Ensure point-in-time accounting, no future leaks. Step 3 is to run the simulation, apply rules across rolling time frames. Track year by year returns, not just averages. Step 4 is measure results. Now, what are these results? Returns, CAGR, absolute rolling 3-month. Risk, maximum drawdown volatility, ratio, Sharpe ratios. Consistency, what is the hit ratio? The difference between a good backtest and a bad one isn't the return number, it's the credibility of the assumptions. Let's take few real life case studies. 1. Small cap momentum. From 2014 to 2017, the CAGR is 25% annually. But 2018 to 2020, the drawdown was nearly 45%. Lesson, momentum shines in rallies but hurts badly in downturn. Value plus quality in banking. PSU banks screened as value. Quality improved with NPA and cleanup. Outperformed Nifty Bank by 6% CAGR with 30% lower drawdowns. Lessons, factor combined with reduced pain, not just chase gain. Third case study is around realty sector. Pure momentum flagged rally, but volatility named created whipsaw. Multi-factor filters kept exposure lower leverage developers. Result, better return with half the volatility. Backtesting across these cycles proved the same truth. No single factor works forever. Blends plus risk filters plus durability. What are the pitfalls of backtesting? Overfitting. A model tuned perfectly to history but fails in real life. Number 2 is data snooping. Keep adding filters until backtest looks good. Ignoring the cost. Brokerage, security transaction tax, slippage all account to 2 to 5%. Look ahead bias. Accidentally using future data in past testing. So what is the golden rule? If your backtest looks too good to be true, it probably is. Better to trust an imperfect but realistic backtest than a flawless fantasy. Simulation and forward testing. While backtesting is looking at history, simulation is stress testing the future. Paper trading and demo mode run strategy live without money. It gives you confidence. Walk forward testing. Train for one period, test for another period, and train again. And this is a walk forward model. You can also use Monte Carlo simulation to generate thousands of random price paths to test your robustness. This ensures your strategy survives not just the past, but also unpredictable future. So what's the way forward? Let's tie it all together. Let's recap our journey. Well, episode 1 to 2, we covered quant basics, rules, and tools. Episode 3 to 5, we covered momentum, value, and quality. Episode 6, we covered multi-factor blends. Episode 7, we covered risk management, survival first. Episode 8, we covered backtesting and simulations. So what does the future of quant investing look like? Disciplined plus data-driven plus adaptive. Disciplined is about rules, no emotions. Data-driven, clean data set, robust backtest. Adaptive, sector rotation, regime switching, and AI-driven factor weights. In India, this is especially powerful. Retail participation is rising, cycles are shorter, volatility is higher, which means disciplined adaptive models will have ever greater edge. At IntelliInvest, our mission is simple: democratize these tools, give retail investors access to quant strategies once limited to Wall Street quant desk. Here's the final truth. Anyone can make money in a bull run, but only disciplined, data-backed investors build wealth across cycles. So subscribe, like and share, और याद रखिए, returns makes you rich, risk management keeps you rich, backtesting gives you the confidence to stay rich. This concludes our quant investing series. But really, the journey doesn't end here. It begins now, with you applying these learnings, testing your ideas, and investing with conviction. It's Manish signing off for today. Thanks a lot for joining.